Right, cool, great. So this last part is really looking at ISAs and a couple other things um, that we'll talk about um, to do with some tax planning. So, like I've highlighted as we've been going along, that ISAs have been around for a long time, and really and truly, ISAs are now useful probably only for additional rate taxpayers because we've been able to see how especially for basic rate taxpayers, how the nil rate band of £1,000 does help to cover a lot of interest on savings. Again, I've highlighted that to be receiving interest on savings of £1,000 a year is not too bad. I mean, if you're considering that savings, probably some of the better saving rates you're going to get of 5%, um, you are looking at a healthy sort of you are looking at a um, if you like savings of 20 grand on average to receive interest of £1,000 every year. That if you're doing 20 grand every single year of savings, that's that's wonderful. So that in itself has enabled, if you like, the ISAs to not be which is roughly that 20 grand is roughly the same figure, if you like, on the 20,000 limit that can be invested tax free. Nice. So the good thing about ISAs though is that still again is to do with the capital disposal. The fact is that any here we are just any an ISA offers the following tax reliefs: income, interest, and dividends are exempt from income tax. So again, if you have dividends greater than the 2 grand, that's wonderful. And disposals of investments within an ISA are exempt from capital gains tax. So that's the point there. Um, yeah, and that's the main point. There is no minimum holding period, but the point here is that's the key point. And we have a range of ISAs now, and there is no um, restriction now on how you place your ISAs. You can have cash ISAs, stock and shares. There is no. There used to be a bit of a restriction as to what some were certain cash ISAs, and you had stocks and shares, but there is no um, restriction on how you spend your 20 grand. You can put whatever you like in a cash ISA and whatever you like in a stocks and shares. And like I said earlier on, because of that, these nil rate bands now, ISAs don't protect that, give off that advantage as they once did. Although, again, like I say, this of course only applies to your basic rate bands. Of course, your higher rate banders and your additional rate banders should still be taking advantage of the um, of the ISAs because they only get 500 and nil respectively. Um, yes, so that's the first point, um, and that's really the main point there. This is last point here. In addition, chargeable gains made within stocks and shares ISAs are exempt from capital gains tax, and these ISAs will definitely be advantageous to taxpayers who make chargeable gains in excess. So when it comes to selling these assets, then of course these are exempt within ISAs, and they are not within your normal sort of day-to-day behavior. But then of course all individuals get an annual allowance of 11,000. Well, it was 11,700 the last time we did this. It's probably gone up a little. But the point is that again, if you're if you're selling off assets and you're making gains of more than 11,700 every single year, which is what you get roughly about, say it's circa 12 grand. We'll see the exact amounts as we come to it. Then of course it still makes sense to please have to go in for the ISA because your gains are exempt. So this is good material for advisory, showing the examiner, especially in section 3, that if a client just literally it will be literally be a straightforward question. I have some money. Do I put it in an ISA or do I just treat it as normal? And of course the question is you're just giving them the limits and the advantages. Right. Now, this is another very important point, and this point is really to do with the fundamental driving point here is I will just open up another screen. I had intended to do TYU2. It's fine. the point here is that income, I mean, I'll go back to the slide again, but just to write a little, income or interest income is taxable on receipt. This is the point here. It's taxable on receipt. It's not accrued. If it was accrued, it would, it would make sense. But when we have a scenario what we're going to see, then we accrue. So again, like I say, because it's taxable on receipt, imagine your year end was, I don't know, whatever, the 31st of December, and you typically received your interest, say, I don't know, twice a year in March, if you like, and of course 6 months later, March, April, May, June, July, August, September, and this was your year end. And imagine you were going to sell this bond, or you decide to sell this bond in February, which is the point here. Now, the issue here, of course, is that when you sell this bond, as you can imagine, if you're happy, if you can see that in terms of finance, you can see that when you have an asset, of course, you would, of course, all interest, whether we like it or not, it's like anything, even a normal share. Yes, you may be recognizing a share at the nominal value, but the value of the business is increasing, and when you come to sell the share, that value is taken into consideration, as is that interest is taken into consideration when you have a bond. A bond and a share are just instruments. The interest is intrinsically, if you like, considered when it comes to actually selling off. But we don't receive it yet, but it's there. So when you sell it as that package. Now, of course, when you sell these assets, of course, you have exemptions. Some of them are tax-free. So it's possible for the interest to escape any taxation at all if it is sold within the context of its bond when it comes to selling. But if you were holding on to it, that interest will crystallize out and we would recognize it. And so to prevent people sort of selling off bonds, or to prevent the escape of interest from taxation, you are asked to accrue the interest up to the date of sale and then recognize that. So you sell the bond on its own separately. So what the government are willing to give you, if you like, is relief on capital growth, if you like, purely due to the demand for the bond itself. But regarding interest, it must be taxed. We need to recognize that. And so that's really the point here. So let's go to this. Let's go to the example here and see where we're going. And this is referred to as bond washing, really. But the point here, as you can see here, the accrued income scheme was introduced to prevent this avoidance of tax on interest. And that's the key point there. So I've already highlighted this. As the interest payment date gets nearer, the capital value of the security, just like anything, as the dividend date gets nearer, the capital value of the share increases, as anyone buying the share will have to pay, if you like, for the accrued income in addition to the underlying capital value. And of course, typically these are exempt from capital gains tax, so this element of growth relating to the interest escapes tax, and so we're trying to avoid that. So literally, we just have to accrue that income. So again, we literally just need to work out what the accrued income will be for that period of time. Yes, well, it says here that the scheme, just a little note here, the scheme won't apply unless the total nominal value of securities held by the individual exceeds 5,000 at some point during the year. So let's look at this. So here we have an example here. So it says Ahmed sold 15,000, 6%. So this is the, if you like, the interest that accrues, 6% loan stock. So this is with interest. So common interest means with interest on the 31st of October 2019 for proceeds of 20,000. So basically he sold this 15,000 asset for 20,000. So there is a gain of 5,000. So the question here is that if you look at the dates very clearly, it says that interest is payable on the 30th of June and the 30th of December. So if he sold it on the 31st of October, in here, there is interest. The last time he got interest was the 30th of June. So interest has started accruing again for July, August, July, August, September, and October. So 4 months of interest were part of this package when sold, and that 4 months of interest has to be realized. So basically, the 450 had come in. Of course, no problem. He recognized it. But of course, what he won't be recognizing technically is the 4 months of interest that accrued between the 1st of July and the 31st of October. He wouldn't show it naturally because he just sold the bond. So all he'd have been showing was a capital gain, technically of 5 grand. He would have said, "Oh, listen, I've made a capital gain of 5 grand." He has annual exemptions of 8, 11, 12 grand every year. All of that would escape that. But HMRC are like, no, 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 no. So you have that 300. So like actually you only have a capital gain of 19,700 because you have interest income of 300 and you need to recognize this interest income of 300 because the gain itself typically, for example, like loan stock is exempt. Even if it wasn't, he would have annual exemption, so it had the potential to escape. See where I'm going? So that's the important thing. All right, I think I can quickly sneak in married couples here. And this is pretty straight. I think we started talking about this here. We said that married couples, of course, well, not married couples. Um, um, yeah, here it says married couples. It's interesting because I don't know, I was naturally expecting to just see partners. I actually thought that this had been changed to just partners, but it seems they're sticking. I'll keep reading this to make sure it's just married couples. I don't know why. If you remember, we talked about how give each other partners can give each other a share of their 10% of their personal allowances. So there are lots of planning opportunities, but I think this is a bit of an old one. I imagine it'll be changing soon, but it still seems only available to married couples. So of course, yes, a married couple may save more tax by transferring a fixed amount of their personal allowance from one spouse to the other. We talked about that. And of course, a married couples, it is married couples, not even partners. Married couples can transfer assets, and it does make sense. It's just planning, really. It's just looking at a scenario and thinking, if I'm in the lower band, if I'm in a basic rate band, and I have a lot of space in that basic rate band, and you're in a higher rate band, isn't it better that I get some of the assets, so that when we have savings interest and when we have dividends income, the person in the basic rate band can utilize those at a much lower rate, rental income, things like that. That's really the point, really. So it's just about reacting to the question and seeing how can we split this in such a way that we can make use of all our saving nil rate bands and well, dividend nil rate bands would be available, but still dividend transfers so that you can get taxed at 7.5% as opposed to getting taxed at 32.1, and then if you like, and things like that. And I think that's really the point. Let's look at this very quickly. So Margaret is married to Alfred. Employment income of 54, and she receives interest of this every year. Alfred gets 20,000 from self-employment. He has no other income. So you can see that really and truly it would make sense, right, to give this savings account to Alfred. She's going to be in a higher rate taxpayer. She's only going to get the 500 nil rate band. He won't get, to be fair, any starting rate income. So I can already tell you straight away that it's not very clever. If she's only going to get 500, and then you have this, and it gets taxed at 40% as well, as opposed to our friend here, Alfred. If he gets that, he'll get 1,000, and it'll get taxed at 20%. So a definite change in savings if he takes it on. And so I think that's the first thing you want to do, to highlight that and to calculate it, and then talk about what they would save by literally calculating out what would happen if Alfred had the funds. I mean, alternatively, she could just put that interest in an ISA, and that would make sense as well. So she could just invest, the interest would be tax free. And it's, to be honest, it's not that much. She could just put all of it in an ISA, and they'd both be tax, if you like, tax free as well. But I think transferring it to Alfred is the first step. Cool, great stuff. So that's kind of the chapter two. I'm sorry, chapter three wrapped up. Again, as usual, please work through these TYUs, all very useful and helpful. Before you start looking at before we start coming to the progress test. I hope to give you the progress test once we've covered the relevant number of chapters. Tax works nicely in that way, where it's based on as soon as you've covered a certain number of chapters, you will get a progress test to review that. Cool, great stuff, and I will see you in chapter 4.